This is the Asia Trade. I'm Annabelle Droulers in Sydney.
I'm Avril Hong in Singapore. Your top stories this hour. Asia stocks look to open mixed this morning as traders digest the latest US jobs data, which is showing signs of sluggishness. Warner Brothers said to be gearing up to reject Paramount's hostile takeover bid due to concerns about financing and other terms. Plus, Japanese chips packaging materials firm Resonac joins us to talk about their business strategy and supply chain outlook.
Well, Avril, we've got the market open this morning, and if there's one key theme we're tracking, it's how investors are thinking about the trajectory for the Fed following that jobs print overnight, and really doesn't unseat the numbers that we got, these expectations. Yes, there's more easing to come, but not substantially more or even anything more than what was already priced in by traders at this point, seeing 2 further reductions in 2026. So we have equities that are coming online this morning, looking a little bit mixed so far, but mostly tilting to the downside. Continuing to watch the Japanese yen, they're holding below that 155 handle as we await the BOJ decision on Friday. In terms of the other big assets we're tracking, oil is certainly among them because we saw oil actually dropping to its lowest level in almost 5 years. And finally, it seems like that big supply glut and the concerns that we have about that are coming very much to the fore. So oil, we have been watching, and oil stocks as well, one sector to be keeping an eye on today in trading. In Asia as well, I mean, the big focus is going to be what we saw in the Golden Dragon Index overnight, but also just with mainland equities, Hong Kong trading yesterday, because we saw them tracking back down to key technical levels around correction territory for the HS Tech, HSCI, MSCI China Index as well. But all of this concern around the Chinese economy, its outlook. One thing to note as well, we have a major trading debut coming up in Hong Kong later on in the morning. But this is MetaX, of course, Avril, which is, again, we had more threads and the big success of that trading debut just a couple of weeks back. Be very interesting to watch a fellow GPU fabricator or chip designer and how it fares at the open today.
Yeah, really the craze over these Chinese chip-related companies. But take a look at the U.S. You talked about the jobs data and how investors are digesting it. There was enough for the hawks and the doves. You look at how the jobless rate ticked up. We also saw that tick higher when it comes to payrolls for the month of November after what looked like a pretty disastrous October. So all in, there does seem to be a mixed picture emerging from the jobs market in the U.S. And overall, I think investors still keeping to some of their bets that we'll see the Fed continue with its cuts. But the data does look a bit choppy, all things considered. We are seeing that continued climb, those gains in U.S. Treasuries. The dollar continued with its softness. In terms of stocks, we all saw that wobble continuing overnight. Even though you're seeing those gains in tech or the NASDAQ, that was really due to the outperformance of Tesla. And this is against the backdrop of investors perhaps taking another look at the company, given its strategy with robo-taxis, which we will unpack later in the program as well. But for now, let's talk U.S. jobs, economy, and bring in chief economist at Bloomberg Economics, Tom Orlik. So, Tom, what was your assessment of the picture that the U.S. economy, jobs market more specifically, is showing us? Because to some, this speaks to the idea that there was enough to support previous rate cuts. But what does this leave in terms of support for the case for future rate cuts?
So I think we share your view, Avril, that this was a mixed jobs report. Our overall impression, though, was one of weakness for a number of reasons. First, we saw an outright contraction in jobs in October, 105,000 jobs lost as those Doge job cuts for the federal government started showing up in the data. And the numbers for November, well, 64,000 new jobs doesn't sound that bad, but keep in mind that there's a systematic bias in the BLS data, which probably means they're overcounting jobs by about 60,000 a month. So if you net that out, well, it's an even sharper contraction in October and barely any jobs created in November. The unemployment rate ticked higher to 4.6%, above expectations. And if you look at where jobs were being created in November, it's in a fairly narrow set of sectors: education, healthcare, construction of those data centers powering the AI boom. So a mixed data report. Our overall impression, though, was one of weakness. Confirms our view that the Fed is not done easing. We think there's many more rate cuts coming in 2026.
Yeah, you're actually flagging the odds of 100 basis points of reduction ahead. So what's your timeline around that, and why exactly? I mean, when you take a look at traders, for instance, they're looking at 2 cuts that they're pricing in for 2026.
So I think there's a couple of factors there, Annabelle. So the first is, well, in 2025, the balance of risks for the Fed has been focused on inflation. A lot of concern that tariffs were going to send prices spiraling higher. We think that inflation narrative has been overdone. When we look at what companies are talking about, we think we're going to see falling price pressure in 2026, and the focus is going to shift to weakness in the jobs market. So the focus for the Fed is going to shift from inflation too high to jobs too weak. That calls for rate cuts. Second consideration, of course, is that there's going to be a change of leadership at the Fed. Powell will be exiting from his position as chair in May. Trump will have a chance to get his person in charge. That's going to change the discussion on the Fed board, and that increases the probability of cuts as well.
Tom, to what extent are these expected rate cuts going to help then to mitigate the problems or the cracks in the labor market, given how, to your point, we are seeing these jobs going to perhaps the private sector? It does look like structural shifts are underway as well.
So that's a really great question, Avril. I think there's some structural dynamics at work which monetary policy isn't going to address, right? There's the immigration story. US essentially closing its southern border. That means less new workers coming into the country. It means less job creation. There's the AI revolution, and we're seeing headline after headline about big companies reconsidering their hiring plans as they think about the capacity of AI to boost productivity. Now, monetary policy isn't going to change immigration. It's not going to change AI. Those are structural factors. But what rate cuts can do is fire the animal spirits of the economy, push markets higher, make it cheaper to borrow, and all of that will provide support for jobs.
Tom, great to have you with us this morning. That's our chief economist at Bloomberg Economics, Tom Orlik there. And just shifting back to Sydney, because we are under 10 minutes into trading so far, but there's one big stock that's standing out to us, and that's Treasury Wine this morning. You can see here it's off 9%, but earlier plunging as much as 17% in the session. So essentially the company has outlined that it's seeing a lot of category weakness in the US and China. That has been 2 of their growth markets. And because of that, they're also being forced to look at asset sales, cost cuts, but a company-wide overhaul. So that stock is very much in focus this morning, with a statement out from the CEO earlier as well about the outlook for the business. But let's also take a look, shifting now back to the US jobs figures, rather, because traders, of course, digesting the report and what it means for trading activity moving forward. Garfield Reynolds, who leads our MLive Asia coverage, joins us now. So, Garf, what was your take? Because it seems like maybe there really wasn't enough to sort of unseat the expectations we already had around easing for next year.
Well, I think, the big problem for the market is that many there might well tend to lean towards what Tom was talking about, that the Fed is going to need to cut rates at least twice, if not more, because under the hood, there are a lot of concerning signs with those jobs numbers. Not just the increase in the unemployment rate, but the increase in the underemployment rate, the increase in people who were unemployed for a long period of time. And all of that signals that, the labour market is definitely under strain. However, the Fed, the dot plot said 1 cut. Some of the language has remained very concerned about sticky inflation, and you have to understand the context that you've got policymakers globally who their last big stuff up was being too slow to hike rates back when inflation took over post the pandemic. So there's a sensitivity towards that. That means the Fed is risking being behind the curve as far as the market is concerned. That helps to explain the fragility, especially in stocks, when they look at these numbers and say, well, we can see there are problems coming and we can see that the Fed might not be about to solve them for us.
Yeah, Garth, a bit of PTSD from the word transitory. They don't want to make the same mistake twice. Is that why yields are where they are? What do you think is an appropriate level for U.S. Treasuries, given the expectations that the Fed will cut?
Well, one of the fascinating things about the last year and a half or so is that government bond yields haven't necessarily aligned all that much with what the Fed is doing. We've had rate cuts, and yet longer dated yields are higher. I think that speaks to the concerns about both in inflation and also the issuance and credibility concerns that are plaguing not just the US, but global central banks and global governments. There's a lot of government spending that is needed to cope with some of the geopolitical strains that are going on, the turn back towards increased defense spending, concerns about the transition, perhaps outside the US more than in the US, towards greener energy. All of that costs a lot of money, plus aging populations. We've got a very strong issuance profile and some serious concerns about whether there's sufficient demand for some of that government debt. So all of that biases yields to the high side unless we get a serious crisis level breakdown that's going to lead to rapid rate cuts, and that's not what's in the picture at the moment.
That's the Fed story and rates and equities generally. What else are you watching in the session today? Because I think China, for instance, was one of the big ones yesterday, moving again into correction territory.
Yeah, I mean, China has flipped around quite a lot recently from, it's time to buy Chinese stocks again, to, wait on. All of a sudden, China Vanke put the property bust back on everybody's radar, and then the economic data has been pretty dire, and the Xi regime is very keen to not panic, to sort of stick with its gradualist approach, and investors are starting to lose faith in that to some extent, and especially heading into the end of the year, who wants to hold on to that? You've got the extra complication that early in the next year you have the big China holiday break, so that creates some complications with how you're going to invest in China, and that's helping to weigh down the rest of the Asian markets because China is such a big part of the regional economy, and where the yuan goes is also a concern for the region. So that's something that we're watching very closely. Can there be an end to these declines? And without an end to those declines, you've kind of got a tough time for Asian markets heading into the end of the year.
We'll watch the open of China markets later on in the session. Garth, thank you so much. Always great to get your insights. Garfield Reynolds, who leads MLive Asia coverage. Coming up on the Asia trade, Resonac shares their business strategy as Semicon Japan gets underway. Standard Chartered Wealth Solutions explains why they expect risky assets to outperform next year. And UBS Investment weighs in on their outlook for precious metals. More ahead. This is Bloomberg. Jared Kushner's Affinity Partners is exiting from Paramount Skydance's hostile bid for Warner Brothers Discovery, and that's as Warner Brothers is said to be planning to reject Paramount's offer in favor of its deal with Netflix. For the latest, let's bring in Bloomberg Senior Executive Editor for Global Technology, Tom Giles in San Francisco for us. So, Tom, talk to us about why Affinity, or Jared Kushner's firm, is exiting from this hostile bid. I mean, this is a guy that's pretty much everywhere when you look at things. What is this going to mean for that hostile bid?
Yeah, well, I mean, his people didn't go into a lot of detail. They just said they talked about the presence of two very strong contenders. You've got Paramount on one hand, led by David Ellison. And then, of course, you've got Netflix, this very powerful and well-capitalized Silicon Valley streaming giant. Two very strong contenders. They have their aspects of both offers that are potentially very appealing to the Warner Brothers shareholders, and this is Jared Kushner and Affinity. They were going to be a small part of it, but an important part of it, bowing out. The question that I have and that we're trying to answer is whether this makes a difference to the president. Right? Jared Kushner is the son-in-law of President Trump, and President Trump has been very vocal about this deal. About wanting it to be competitive, is saying he takes issue with parties on both sides. He wants it to be competitive. And so the question is, does his removal make it easier for Trump to oppose the Paramount bid?
Yeah, that was what exactly I was going to ask you, Tom. What does it mean, and given the proximity and Jared Kushner is Trump's son-in-law and the indications that he'll want to get approval? But in the meantime as well, I mean, why exactly is Warner Brothers looking to reject Paramount's offer, and what are the T's and C's that are just so unpalatable to the business as well?
That's right. They are concerned about how this is going to be paid for. Remember that David Ellison is also relying on the considerable wealth of his father, Larry Ellison, right, the co-founder of Oracle, who is still the CTO there, who has an immense amount of wealth. But there's aspects of the fund from which the trust from which those funds would be removed. And I don't want to get too technical here, but it's a revocable trust. And the concern is that there's the potential for those funds to be removed without Warner Brothers' knowledge or permission. Again, this is an executive who has tremendous wealth. He's one of the wealthiest people in the world. But remember that, he's still running a business, and he's highly levered, and he is borrowing lots to pay for the big build out of data centers for Oracle, the company that he is closest to and owns a big stake in. Again, Warner Brothers didn't go into all of that detail in what we expect to be a rejection, and we expect that to come as early as tomorrow.
Tom, great to have those insights, and I think a deal, of course, it's going to shape the entertainment industry whichever way it goes in a very major way. But that was Bloomberg's Senior Executive Editor for Global Technology there, Tom Giles. And let's shift now to Tesla shares, because they closed at a record on Tuesday. This is amid rising optimism about the company's self-driving and robotics efforts. That's even as its EV business continues to face challenges. For more, let's bring in our equities reporter, Jordan Fitzgerald, joining us. And Jordan, we've got this really great chart, and I think it really points to the way that Tesla is being reconsidered or reappraised by investors, because it shows again that company managing to power through, even though when we had the latest retail sales, for instance, we saw weak car sales. So investors are clearly not just thinking about this company as an EV business, but more about the future growth drivers, it seems.
Yes, good morning, both of you. Tesla did close at a record high for the first time, almost to the date in a year. Last year, that record came amid the Trump trade and the bullishness after Donald Trump's second election to the office of American president. And that's back before Elon Musk and Donald Trump had their falling out. So people were really betting that 2025 was going to be a strong year for Tesla. And in some ways that really bore out, and in other ways it didn't. The stock fell to a massive low in April, I think almost 50% from that previous record high over the tariff offensive as well as that weakening relationship between Musk and Trump. But it's been on a tear ever since. Shares have, I think, over doubled since that low point. And now we finally have passed the threshold of a new record high that Tesla's kind of been flirting with since about October.
Jordan, when it comes to self-driving and future growth, we are also hearing developments that could support the likes of Waymo.
Yes, I think when we heard all of these, AI names and dreamt of a dystopian future, the thought was always the robots are going to warn off the robo-taxis. But that's really what's been manifesting in this space. Waymo, Uber, Tesla, Rivian, Lucid, they're all really, really trying to home in on a functional robo-taxi. And so Waymo announced that it would be raising more than $15 billion, which would value the company at around $100 billion. That's more than double its last funding round last year. And this didn't really have too much an effect on Tesla and Uber and Lyft stocks in the post-market, but it certainly shows that this isn't a space where any company can get complacent.
Jordan, thank you so much. Our Bloomberg equities reporter, Jordan Fitzgerald. We have more ahead on the Asia trade. This is Bloomberg.
The Australian Treasurer, Jim Chalmers, is expected to announce slightly narrower budget deficits when he releases a mid-year fiscal update just in a few hours' time from now. Let's get more from Bloomberg's Paul Allen, who's joining us this morning. So, Paul, what's in, what's out, and how have we managed to find some extra savings here, or how's the government done it?
Well, as is tradition, things tend to trickle out ahead of the announcement, and Jim Chalmers has already said that there's going to be no renewal of the energy rebate scheme. That was to help with cost of living pressures around that, so that's gone, but we knew that. There's been $20 billion in savings elsewhere, according to some of the reporting around this. And just trimming around the edges, really, cuts to consultants, to labour hire. That's saved about $5 billion. Government departments have been asked to trim about 5% from their budgets heading into next year's full budget. And on the revenue side, good news. As usual, commodities have outperformed the also traditionally very conservative estimates. So the total deficit's expected to come in at $24.4 billion. And I'm giving a US dollar number there. It's about $5.5 billion less than projected in last year's budget. But while savings have been found elsewhere, cost pressures are rising. Age pensions, disaster relief spending has gone up. And then there's the hugely popular home battery rebate scheme. The cost blowout for that has been extraordinary as well. So there are spending pressures building also.
So that's on spending. What is he expected to say about the outlook?
Well, all the rhetoric leading up to this has been cautious, conservative, choose whatever synonym you like for those. It's all been an exercise in managing expectations here. Narrower deficits are forecast across the horizon. Spending growth is really being reined in as well. It's about half the 30-year average. So Jim Chalmers here really mindful of not fueling inflation. Now, on that note, we get a new set of Treasury forecasts as well around not just inflation, but also growth and unemployment. But it's the inflation number that's going to be really closely watched, because the Reserve Bank of Australia has signalled that, look, inflation's sticky. Can't rule out that the next move here is going to be up. More broadly in the macro picture, there's certainly a case to be made for having a big conversation about taxation reform in Australia, but no political party of any stripe is really willing to get into that for fear of voter backlash.
Paul, all right, we'll be watching then that being handed down in a couple of hours from now. Well, that was Paul Allen there with us in Sydney. We'll have more ahead on the Asia trade. This is Bloomberg. taking a look at markets this morning, we've got Nikkei futures looking like we might see some very modest gains at the open, but broadly we are looking for equities that are going to be slightly risk off, and that very much reflects the trading activity we saw on the Wall Street session overnight. But traders just continuing to digest these US jobs figures. A pretty mixed report, and if you look under the hood, it definitely shows some signs of cracks forming in the labour market, but traders still pricing in 2 cuts for next year. But let's shift back to Japan, because of course Semicon Japan begins today in Tokyo, bringing together business leaders in the semiconductor manufacturing supply chain. One of those participants in this is semiconductor packaging material supplier Resonac. Joining us now from Tokyo is its president and CEO Hidehito Takahashi, joining us. So Hidehito, thanks very much for your time this morning, and I want to start with your business outlook, because as a business, Resonac is very much aggressively pursuing or pivoting towards semiconductor materials in particular. What does the demand outlook look for you right now?
Yes, thanks for having me. It's great to be here. And outlook of the demand for the next year is very strong. Everybody in the industry is talking about AI-related demand for semiconductor is going to be strong for the next year. People are not talking about the following year. Of course, semiconductor usually has a cycle, so people don't predict too much ahead, but next year is going to be a very good year.
And are there any particular materials, for instance, materials that are linked to HBM? Which ones are standing out for you in terms of your business?
We have a film called non-conductive film, which is necessary to produce this HBM. And we have about 50% of the share in this HBM market, which is very strongly leading our performance.
It's also about this transition in the industry from chips to chiplets and the idea of perhaps lower costs. So what are you seeing as a material supplier and demand from that, the adoption, the take-up rate for that side of the business as well in the industry?
I think a chip-to-chiplet is actually happening already, and I guess the next generation of the movement is we are moving from this a wafer to sort of a square interposer. So we are targeting that next generation game changer. We formed a consortium called Joint 3 to cater for that change.
And to what extent do you think that's going to contribute as a proportion of growth for the next 2 years, Hidehito?
Next 2 years, it's going to be still around this, AI-related materials such as thermal interface material and non-conductive film. I guess the Joint 3 activity for this panel process is going to happen in around 2030.
You've got business operations both in US markets but also in China, so you're certainly having to, I guess, manage those tensions we see between the two economies. But when you think about your investment outlook as well, or CapEx, where would you be more likely to push investment, and what are the pros or cons of expanding your manufacturing base in the States as well?
We are the back-end material company. Thinking about the United States, we don't have an ecosystem for back-end material yet. Usually, semiconductor industry starts from, of course, semiconductor company, then equipment company, and then front-end material company. Finally, when those ecosystem established, back-end material companies move in. So we'll see how that development goes as far as US is concerned. And for China, we are ring-fencing China, so to speak. We are producing China and selling in China. China is a good market.
And so we can get maybe more on China in just a moment, but what would be your timeline then? And to your point, I mean, we're just seeing the likes of TSMC scaling up its operations. SK Hynix is scaling up. I mean, there's many companies that are scaling up in the States. When would you look then to shift?
Again, as I explained, TSMC and SK Hynix, ramping up the operation in the States. Then, if we have ecosystem for front-end material, equipment, and wafer, and then back-end material companies move in, so it's going to take around a few more years.
Hidehito, what are you seeing among the challenges for obtaining critical minerals, materials. I mean, that certainly has been a key challenge for materials firms and other AI-related companies this year.
Well, as far as our materials are concerned, of course, we have a few materials we procure from China, but we are always looking for a second source, third source. I don't see any foreseeable futures risk regarding these minerals from China as far as Resonac's operation is concerned.
So you expect the supply chain next year to look quite stable, and does that mean that there's less of a need to perhaps make these supply chains a bit shorter in terms of having things closer to where Resonac is based?
I don't see, well, as far as next year is concerned, I think the supply chain is going to be relatively stable. Key players have capacity lined up for the next year's growth. So I don't see any immediate risk about the supply chain for the next year.
When you're saying there's a certain rare earths or raw materials that you're trying to diversify away from China in particular, can you tell us which ones those are and where you're looking to secure them from as well?
We have some materials going into CMP slurry procuring from China, but we are looking for other countries such as Australia or some European countries.
And sourcing from a non-Chinese partner, what does the price dynamic look like around that? And does it have any sort of meaningful impact on your business?
I don't think so. Price point is not necessarily the challenge for us. It's more like a specification. We have to make sure that that could be specified to our customers.
When it comes to Japanese companies, certainly they have also been coming under pressure because of some of these perhaps supply chain concerns, despite what you're seeing into next year and how that might look quite stable. What is your assessment of the extent in which they maybe need to diversify where they're sourcing these rare earths from?
I don't hear a lot of stories about supply chain challenges in Japan. I have a lot of colleagues in Japan, CEOs, but I didn't feel that much pressure from for diversifying the source of materials that much.
Can you talk to us also about the sort of demand you're seeing from the automotive side of the business, even as you perhaps put more prioritization towards AI-related growth?
Well, to be honest, our materials, well, some of them go into automotive, but automotive-related semiconductors are more conventional compared with AI cutting-edge technologies, and Resonac is relatively strong on this cutting-edge arena, so we don't feel a lot of pressure from the automotive side, and we don't feel any changes on the demand that much for as far as Resonac's operation is concerned regarding automotive-related semiconductor.
Let's talk about China, because as you said, you're ring-fencing your Chinese business, and you are saying that the demand there is looking very strong or robust. Just can you put that into more concrete or specific terms for us? Just how good is it looking in China right now, and why do you think that is?
Well, what happened is that because of this some tension between U.S. and China, China started to manufacture their own semiconductor instead of importing semiconductors. So Chinese local players are developing their own semiconductors, and their growth is relatively strong. So what we would like to do is we would like to capture that growth by investing in China. Manufacturing facility in China so that we can produce in China and sell in China.
Yeah, we actually had a Bloomberg scoop earlier this week about maybe $70 billion or thereabouts, or up to $70 billion being directed into China, building out self-sufficiency in its semiconductor ecosystem. So what kind of investment are you looking at making there if you're looking at building up your manufacturing capabilities?
Yeah, well, we don't have any immediate investment plan for China because we have invested in the last few years already for capacity to cater for China. So I think we are pretty good for the time being. Maybe in a few years, if this growth of local players are real, we may have to think about the next round.
And in terms of your business, I mean, how well insulated are you as a company, and how pivotal do you expect to be in the Chinese ecosystem as well?
And it's interesting that I think if China is trying to establish its own ecosystem, they will start from equipment, and then they'll go into front-end materials. Back-end materials comes last, because back-end materials, each market is relatively small, and it's very tedious to produce materials. So they probably will consider back-end materials last. We're feeling relatively okay on that end at this point.
Hidehito, it's been great chatting. Thank you so much for sharing your plans for the business with us. Hidehito Takahashi is President and CEO of Resonac. We have more ahead on the Asia trade. This is Bloomberg.
We're checking Tesla in late trade this morning because we're actually seeing it dropping here off the back of some reporting. We do understand that California Tesla sales may be suspended. That's according to what we have so far. So we'll bring you more details on that. Of course, Tesla shares just hitting it overnight, or in the Wall Street session, a fresh record. So we are, of course, just pulling back slightly from that.
Yeah, and speaking of stocks that have been going gangbusters, I guess major chip companies in China have also been in the spotlight, and one of them debuting today, an eagerly watched one by stock market investors after the stellar gains of its peer MoreThreads earlier this month. Let's bring our China correspondent Min Lo in Hong Kong. Min, you're watching MetaX. Tell us more about this chip startup.
Yeah, very closely watched in China. As you said, it's about 2,900 times oversubscribed in the retail portion. So enormous interest from retail investors. And following just about over a week after MoreThreads debuted in Shanghai as well. And we all know that stock had a stellar opening day, flipping as much as 500% at one point. And like MoreThreads, which was started by an ex-NVIDIA employee, MetaX is also started by a founding team. 3 of them have worked at AMD before. It is a seller and designer of GPUs that are used for AI inferencing, for visual rendering, and for AI development as well. And the company says that one of its chips is closing the gap with NVIDIA's H100 chips. So this is obviously a company that is benefiting from the domestic substitution theme. But of course, one uncertainty is regarding the NVIDIA H200, which is now approved for sale in China. But so far, the Chinese government has yet to provide a clear guidance as to whether or not Chinese companies will be able to buy those chips. So a lot of interest. We're watching it, how it performs later at the star market. It is still loss-making at this point, but this is one of those companies like MoreThreads that is taking advantage of this new channel for unprofitable companies to list on the star market as part of the Chinese government's effort to support some of these strategic industries.
Yeah, so it's going to be really interesting to watch, just given that surge you saw for MoreThreads on its debut. But it's not the only company making a trading debut today in Hong Kong. We've also got the crypto exchange HashKey, and you also spoke with the CEO yesterday. So what are we expecting on this front?
Yeah, HashKey is a leading crypto exchange in Hong Kong. It also has a license to operate in Singapore, Japan, Bermuda, in the UAE. So it's the securing of these licenses has been key to the company. It's a competitive moat for the company. It is priced at a premium to some of its peers, including Coinbase and Futu, for example, which shows you that the underwriters are valuing this company quite highly, and also going to be closely watched because it's coming at a time when there's been a lot of volatility in the crypto market so far. In the past 3 months, I think Bitcoin has lost about 25% of its value, but the company says in its prospectus that it is going to use a part of the proceeds to expand its global markets. It's also going to use part of it to upgrade its infrastructure. We have that interview with the CEO, which is going to air 9:30 a.m. local time, so stay tuned for that.
All right, Min Min will be watching that interview there. Exclusive one for us as well. That was our China correspondent, Min Min Lo. But let's also get the latest on the corporate front, because Bloomberg's learned that China's Luckin Coffee is mulling a bid for Nestlé's Blue Bottle Coffee to boost its brand profile and expand in the premium coffee segment. Sources say Luckin is also evaluating other acquisition targets, including the operator of percentage Arabica coffee stores in China. Founded in 2017, Luckin's expanded with thousands of stores offering low-cost coffee, surpassing Starbucks in store numbers in China. China Bunkers unveiled a revised bond extension proposal for creditors to vote on as it makes another attempt to gain support for a plan to avoid default. The company's offering to pay 60 million yuan in interest due on December 15 by the end of Monday, and is proposing to extend its grace period to 30 trading days. Bunkers scheduled to hold a bondholder meeting on Thursday to discuss the latest proposal. The Information is reporting that Apple's planning a major expansion of its smartphone line that could see it selling at least 7 new phone models or models of its iPhones by fall 2027. Sources say the company will release its first foldable iPhone in fall 2026, which will have a wider than tall appearance when unfolded. Apple is also expected to release a 20th anniversary edition of the iPhone in 2027. We'll have more ahead on the Asia trade. This is Bloomberg.
We have some breaking data crossing the terminal out of Japan for the month of October. Core machine orders on month. The expectation was for a fall of about 2%. We are actually seeing it going against, defying the odds and climbing 7%. And this is, of course, a leading indicator for future capital expenditure. It gives us a bit of a pulse check on the economy as well. We are seeing dollar yen hovering quite flat, steady around the 155 handle. I think the focus for traders is still going to be on BOJ Day, but some other headlines we're following as well, Belle.
Yeah, that's right. The Trump administration's threatening to retaliate against the EU over efforts to tax American tech companies. The Office of the US Trade Representative said in a social media post it would use every tool at its disposal to counter the EU's measures. The department signalled out prominent European companies, including Accenture, Siemens and Spotify, as possible targets. President Trump's push to loosen China's influence in the Panama Canal has reportedly hit a snag, with Beijing upping its demands in a deal to sell dozens of ports. The Wall Street Journal says China will block the ports deal with a BlackRock-led group unless Chinese shipping company COSCO gets a majority stake. BlackRock and its partner were open to offering COSCO an equal stake, but the new demands are said to be unacceptable.
Belle, we also have some breaking coming out from the U.S. president himself in terms of this commentary on Venezuela. Of course, this is a country that has been targeted by the U.S. in terms of a so-called blockade that Trump is said to be ordering at this point, given how they are trying to stem the flow of drug trafficking. Certainly now the U.S. president has been talking about the blockade that he's ordered of sanctioned oil tankers in Venezuela, talking also about how they've completely surrounded the country by the largest armada ever assembled in the history of South America. He says that there will be nothing like they've ever seen before. So certainly very strong words coming from the US president. And in terms of the market reaction, you are seeing a bit of a knee-jerk climb in terms of US crude futures or WTI. But the focus of the markets has certainly still been on this oversupply, the glut, especially against the backdrop of potentially us getting a peace deal between Ukraine and Russia. So oil prices have been hovering towards the 55 level. We are seeing also those declines in Australia on energy majors. Belle?
Yeah, that's right. That supply glut very much in focus. Let's also shift our attention to Tesla that's dropping again. It was earlier down as much as 2% in late trade, so you're coming off that, but still weakness there. Off a record high for the company as well in the intraday session on Wall Street. But the story here is that Tesla is going to have its sales suspended in California for 30 days, and this is a penalty for allegedly misleading consumers about its driver assistance technology, and that's according to the head of the state's motor vehicles department. So the agency has decided to adopt the recommendation of a suspension from an administrative judge, but it's not going to actually be taking effect for 90 days to allow Tesla to come into compliance. So Tesla sales, again, just to recap, in California set to be suspended for 30 days. So that is the Tesla story. But let's take a look at the broader markets as we go into break here, Avril.
Yeah, to your point about Tesla, it's really interesting, right? Because we are seeing how increasingly it's being taken as a non-auto company. And we were talking earlier about how U.S. retail sales, the auto component was a bit of a struggle. We are still digesting, of course, those U.S. jobs numbers, and they give us a mixed picture, something for everyone, whether you're a dove or a hawk. But I think for futures, if you look at the way they're pointing, even though we might see a bit of a bounce from the 2 sessions of declines in Asia this week, overall, the narrative has been this rotation away from tech towards the value trades, your financials, right? So think about your banks. And then we are going to be watching the likes of MUFG as well. We are hearing about leadership succession plans. So certainly a lot to keep an eye on in the session today in Asia. Belle?
Yeah, and again, just going back to some of those particular movers, Treasury wine, for instance, has been one in Sydney this morning. You can see the broader gauge off 0.25%, but Treasury wine plunging in the session so far today because it's been flagging the risks essentially from a slowdown in China and also the US. And so the company is flagging that it's going to have to really adjust its assets, make some major changes to the business as well to accommodate for this. So you've got the likes of Citigroup commenting on this, and they're saying that the new CEO is pursuing a sensible strategy here, but still it's going to be putting pressure on the balance sheet. So we'll have more context on that ahead. The market opens in Seoul and Tokyo are next, and this is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. We had data out of the U.S. showing us a mixed picture when it comes to the jobs market. Jobless rate ticking up, as did payrolls for the month of November, despite a pretty disastrous October. So something for the hawks and the doves. But the key thing to watch in markets as well is whether we're seeing a continued rotation out of those high-flying tech stocks, given the continued concerns about valuation risk. Are investors demanding ever more for that AI payoff? Certainly among the stocks that we're watching in the session today, they also include the likes of the Tesla suppliers. We're hearing about how their California sales might be constrained. We are also watching some of the energy-related stocks in the session, given how oil prices have been trending. That being said, even though oil prices have been pointing lower and we're seeing it breach those support levels, the Venezuela comments from the U.S. president, does that change the picture a little bit in terms of the risk premium? You are seeing it flat on the Japanese markets at the early goings. We did get those Japan core machine order numbers, and even though you saw that gain, defying expectations for a decline for the month of October, and of course is a leading indicator for capex, for the health of the economy, a picture really is hyper-focused on the BOJ and the odds of those rate hikes. later this week. In terms of specific sectors we're watching, of course, is the banking names, given the higher yields, the upward pressure there. You're still seeing that in JGBs, but also think about how some of these big banks, MUFG, they've been telling us about their succession plans, the expectations of fueling growth, even against the backdrop of very supportive rate environment. Dollar yen not giving us much direction. Let's take a look at how South Korea is faring. It looks like it might be another troublesome day, especially when it comes to tech. We are seeing that already playing out in Japan. For the moment, you're seeing a bit of a bounce for South Korea after a bit of a struggle. But this is, note here, a market that has been an outperformer in the Asia Pacific for much of this year. And yesterday, I think the declines in tech in particular raised a lot of eyebrows. Dollar Korea won also fairly steady at the 14.74 handle. Let's take a look at Australia. We are expecting shortly the economic outlook from the Australian Treasurer, Jim Chalmers, and that would give us a sense of not just whether we see it slightly narrower budget deficit, reining in spending, it's managed to clinch some of these savings, but also the economic outlook going forward. We are seeing Australia still continue to come under pressure, and that seems to be the trend in markets today. Now, joining us now is Daniel Lam, Head of Equity Strategy at Standard Chartered Wealth Solutions. So, Daniel, there are a couple of things to watch in the markets. What is top of mind for you? Because it looks like a bit of a struggle into the end of the year. Is this just repositioning? Traders have just clocked off for 2025, or is this more worrying signs that we need to pay attention to?
Right now, I believe the market number one concern is about the AI stocks. Are they going to get back, the returns that they have projected after such big investments? How are they going to finance for this kind of investments? Because many of these companies are tapping for the debt market right now instead of using the free cash flow. So it's not as clear a picture as, say, this year or a few years before. So that's what we see as the number one key risk in the markets right now, and that's the reason why you're seeing the correction.
So you're expecting this to continue for the next couple of months, or is there something that could turn this dismal sentiment towards AI-related stocks around in terms of perhaps earnings growth as a driver?
Well, earnings growth has been strong. It is more about the guidance of the companies. So towards the end of the last, the Q3 earnings season, basically, there were a couple of companies that have demonstrated some weakness, right? At least markets feel that the guidance was not as good as what they're expecting. And, it's fair to ask because at such valuations, people would be asking a lot, for them to perform, both in terms of results and also in forward guidance. So that's fair ask. But at the same time, you have to understand that, over the last few years, we've had a number of false starts for the value stocks. And these kind of value rotation never lasted for a prolonged period of time. So actually, we're not expecting this time to be any different. We believe that investors should still be adding to the AI stocks on the dips, because if you look at how much they're dominating the U.S. Economic growth, this year, basically 2/3 of the U.S. economic growth comes from AI or AI-related investments. That's a lot. And the CapEx is projected to be growing at 40% again next year. So that's hefty numbers. And they're still going to carry the flag for the U.S. economic growth.
Given your point, though, about how concerned investors are about this AI payoff, and that seems to be lingering, might it not make sense to perhaps pick up value tactically?
Tactically, but how much tactically? If you're for the medium to the longer term, the growth area is still on the technology stocks. So, our stance would, rather than trying to catch that value bounce, it is probably wiser to be looking for levels that you like and be adding on dips for the AI and technology stocks in general.
Does that mean that next year, in terms of the markets that can outperform, is it still going to be the likes of Japan, South Korea, Taiwan in your mind? Because we have been seeing this narrative emerging about the likes of India, for example, that they might benefit because they don't have an outright way into the AI trade per se.
Well, India is a little bit different because it's a very domestically oriented market. And actually, their latest GDP growth number was very encouraging. It's at 8.2% versus the projected 7.4%. So that means that the government tax reform has been working into the real economy. And also the monetary policy has been easing as well. So that's good to see. And earnings seems to have bottomed out. So actually, it's a market that we like. We're overweight India next year.
On top of that, what are you seeing in terms of perhaps the rupee weakness feeding into the appeal of Indian stocks as well?
Well, basically, that helps the Indian companies to be, for the exporting companies, it actually helps them. So that's a good sign to see because they do export services as well. And in general, the market this year has underperformed. So the valuation is, people are always saying that India is expensive, but it's gotten to a more reasonable valuation now. So that's another plus that we see in the markets.
We've also been seeing going the other direction from the rupee is the Chinese yuan. I wonder, how do you see that figuring into the equation when you look at Chinese stocks?
Basically, yes, the yuan is looking relatively strong versus the recent past. But at the same time, I would say that China's economic data has not been stellar, right? The last set of data. So the government would probably be having a bias towards an easier monetary policy rather than a stronger one. Okay, so the yuan is probably going to be staying around the current level, unlikely to be appreciating significantly from here.
And how might that feed into what you're seeing in Chinese stocks? I mean, where do you see the momentum coming? Are there specific sectors that you are especially optimistic on?
Well, we have just got a truce between China and the US. I mean, going back to October, you're seeing that basically Trump was saying that he wants to slap a high tariff on China and never came to fruition. And it is basically a truce out of convenience, as I term it, because of the fact that they have leverage on each other. So China has the rare earth card and US has the lead in technology. So both sides believe that it is best to have a truce out of convenience so that they can work to lessen the leverage that the other side has on them. So for China, it is about catching up further on the technology side of things. And that's where we believe the opportunities lie in Chinese stocks.
How else are you positioning as well? Because we are all hearing about that consumption push that authorities are trying to engineer. How might that also affect positioning?
Well, basically, there's the anti-involution campaign. But I believe that is still going to take some time. If you look at the earnings for the consumer stocks that are under heavy price competition, they're not there yet at this moment in time. So for the first half of the year, the positioning is about going for the stocks where there's AI technology and self-sufficiency theme. And after that, perhaps revisiting the stocks that can benefit from the anti-involution, because the end game is going to be that you'll be left with a few big players, right, such that they have finally got the pricing power, and the smaller players will be pushed aside.
When it comes to policy, Daniel, I got to ask you about the policy mix out of the U.S. and how that is going to affect the overall trajectory for Asia stocks in the first half of next year.
Well, the Fed is saying that next year they will be cutting once more. But with a Fed new chairperson, perhaps that will be tilting towards the dovish side. So our stance is that next year there's probably going to be 2 to 3 rate cuts from the U.S. rather than the one that the Fed has mentioned in the last FOMC. So if that's the case, that the dollar is going to weaken more, and that is probably going to be helping the EMs, okay, because they usually do well when dollar weakens. So that's the reason why we are overweight Asian stocks. And also in terms of the EM local currency bonds, we do like them as well.
Okay, weak dollar helpful for Asia assets. Daniel, thank you so much. Good to chat. Daniel Lam, Head of Equity Strategy at Standard Chartered Wealth Solutions. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at the stock of Tesla that has, after a year, finally hit a record high, but we are seeing a bit of a stumbling block in terms of after hours. Take a look at how it fell as much as 2+% earlier, though it's pairing some of those losses in extended trading. And this is following on from news that after a review period that Tesla faces a sales suspension in California, but certainly for investors, the focus has been about self-driving, how it's pivoted the company. Now it's not seen as just an auto firm. It's really also about its robo-taxi strategy. You're looking at Tesla suppliers faring pretty mixed in the session. In the meantime, Bloomberg has learned that Alphabet autonomous driving unit Waymo is in discussions to raise more than $15 billion at a valuation near $100 billion. Sources say the robo-taxi maker has discussed raising billions in equity from external backers as well as its parent company. Big Tech editor Sarah Fryer joins us now. Sarah, so talk to us about this financing, the funding, and what we know of it.
Well, these are early talks, but this is a major investment by these backers in Waymo's expansion. This company is the only one that's doing driverless vehicles with no human in them in multiple U.S. cities, really taking the lead versus Tesla and others in the robotaxi market. So I think that it's just ramping up that momentum and showing its progress. Now, Waymo uses a different kind of self-driving technology, a few different kinds of sensors compared to Tesla. We are seeing that this is one of the other bets units of Alphabet that is very much ramping up, succeeding. That unit has had some struggles, and this is one where they're really seeing a potential future for this company within Alphabet.
Yeah, we are seeing it sort of that front runner against Tesla, but this is also against the backdrop of Tesla perhaps getting relooked by investors after what has been quite a troublesome year. What are you seeing in terms of the shaking out or the way the robo-taxi race is shaping up?
Well, it's currently, as it stands, I mean, it's shaping up with Waymo as the leader here in San Francisco. People take Waymos very regularly. There are some Tesla vehicles, but it's not nearly as ubiquitous. If you go down the main road, Market Street in San Francisco, you just see Waymo after Waymo. People are using them the way they would use Uber and Lyft. So I think you're starting to see a picture in across the U.S. in several markets this year. They're launching in Japan and a couple other markets internationally as well in the coming year. I think that you are seeing it start to take shape and become a habit for people in a way that we feel is new. It's a new sort of dominance for this company.
You know, when it comes to the financing or the funding that it's getting, what's interesting is also that it's being able, Waymo, to take some of this outside capital. How is that perhaps going to insulate it a little?
Well, what's interesting about Google's strategy with its other bets like Waymo and Verily is it's trying to set them up to be independent companies. For a very long time, these so-called moonshots at Google were just large financing black holes where Google would put a lot of money in and not really see a lot come back. We're reporting in our story today that Waymo has achieved a 350 million plus revenue run rate. So that's very different than the picture from a few years ago where they were just investing without much return. That said, the expansion to various cities and internationally is going to be dramatically high expense endeavor, and Google is already spending a whole lot on building out AI data centers, all of the AI boom related financing, and so it does need these external backers in order to make Waymo a business that is financially viable for the company.
Sarah, really good to get this context from you on this robo-taxi race. Big Tech editor Sarah Fryer for us. Let's take a look at how Japan assets are faring across the board as well. It is a big week in terms of the messaging we are hoping to get from the BOJ. It needs to not just hike this week, but also signal enough hawkishness for there to be sustained gains on the Japanese yen and a bit of that breakout from where we're seeing looking very range-bound for the moment. We are seeing it still quite tepid on Japanese stocks. In terms of equities, we're also watching SBI Shinsei Bank that has started trading in Tokyo. And this is, of course, Japan's second biggest IPO of the year, and it's surging about 11% for the moment in the early goings. Another company that we are tracking in terms of lenders, the mega bank, Mitsubishi UFJ Financial Group's succession plans, because we're hearing how the next CEO, Junichi Hanzawa, will be taking the reins of Japan's largest bank, and this begins April next year. Hanzawa faces the challenge of sustaining growth beyond the boost from higher interest rates.
To stay globally competitive, we need to capture even more growth in Asia and the U.S. For the areas we can't fill on our own, we will consider addressing those missing pieces through inorganic means as well.
Let's bring in Asia investing and finance editor in Tokyo, Russell Ward, for us. So, Russell, tell us more about this incoming CEO. Of course, he is already leading a big part of the bank.
Morning, Avril. Yes, that's right. Hanzawa-san will be coming in as the first management change at the top of MUFG for 6 years. But really, it's quite a sort of a typical for these big Japanese banks. He's an insider. He's worked for the bank for his entire career. So it's very much a continuity sort of a situation. He's seen as a safe pair of hands. Most of his experience is on the domestic front in areas like strategy and regulatory liaison, that sort of thing. But as you showed in that clip there, one of his big challenges is sort of sustaining the bank's growth, and that involves having a very much a global outlook, because although interest rates are rising at home, there's a lot of tailwinds at home with also the bank selling a lot of its cross-shieldings and booking gains on those. Those factors aren't really sort of sustainable that much in the long run. So for the bigger picture of things, he's going to have to be looking abroad. His predecessor, or the incumbent, has been pursuing a lot of acquisitions, spent about $8 billion during his tenure, and that is really something they're going to have to continue doing. Of course, we broke the news this week that MUFG is looking at buying a stake in an Indian non-bank lender. That's just the latest example of the sort of efforts that Hanzawa-san will have to continue to pursue.
On top of the growth drivers for the lender, what about how it'll need to foster its relationship with some of its big shareholders, Morgan Stanley?
Well, actually, yeah, MUFG is a big shareholder in Morgan Stanley. So they have the two companies have had a deep relationship ever since the global financial crisis when MUFG came to the aid of Morgan Stanley. They've been deepening that relationship, and MUFG has been actually booking a lot of profits from Morgan Stanley itself, which has obviously turned around incredibly in recent years. And that relationship has been deepening also on the domestic front here in Japan with investment banking. And so, Hanzawa-san, his predecessor, Kamezawa-san, had a good relationship with Morgan Stanley CEO Ted Pick. And Hanzawa-san will certainly be wanting to continue that.
We'll watch what his leadership brings in April next year, the changing of the guard, so to speak. Russell, thank you so much. Good to have you with us. Asia Investing and Finance Editor in Tokyo, Russell Ward. We have more ahead on the Asia trade. This is Bloomberg. Following on from those U.S. jobs numbers, we still have inflation data later in the week to contend with. Citadel founder and CEO Ken Griffin says Republican policies on tariffs and immigration are currently driving inflation. Speaking with Bloomberg in Paris, he thinks in the long run, their push for deregulation will ultimately stem those pressures.
The big picture is the American consumer is tired of the persistent and sticky inflation. They feel like they can't get ahead in a world where their savings and their wages are constantly deprecated by the impact of inflation.
Why aren't Republicans speaking to that? Is it an issue of not having the policies, of not communicating the policies correctly?
So I think it's actually fairly complicated. I think that the Republicans struggle with the reality that many of their policies, which they ran on, for example, ending illegal immigration into the United States, are actually pro-inflationary, right? When you end illegal immigration, you reduce the size of the available workforce, that's pro-inflation. And so the Republicans are grappling with tariffs, another case study. You impose a tariff, it's a regressive tax on consumers, it's pro-inflation. So some of the very policies that the Republicans have put forth and have been successful in implementing are actually the very policies that tend to be pro-inflation. Some of the other policies, for example, deregulation, are just going to take longer to play out. And ultimately, deregulation, which should unleash productivity gains, will create a reduction in inflation, a very healthy reduction. But we need to get to that point in time.
Citadel founder and CEO Ken Griffin speaking with Bloomberg's Danny Berger. We have more ahead on the Asia trade. This is Bloomberg. We have some data crossing the terminal out of the Lion City. Take a look at how exports numbers have come in for the month of November. We are seeing it more than expected in terms of a gain, almost 12%. 11.6% is the number. This is better than expectations. The prior reading for the month of October, though, we are seeing that reverse a bit lower, revised downwards to 21.7% growth. Electronic exports also looking pretty upbeat out of Singapore. Of course, this is among the Southeast Asian economies that seem to be able to defy expectations that exports or trade would tail off towards the end of the year, given the risks surrounding tariffs. Singapore has also recently upgraded its economic outlook for the full year following a strong third quarter. Now, we're going to keep that conversation on Singapore because a bet on Hong Kong and China's real estate sector is backfiring on one of Singapore's top banks. We're talking about UOB, that is now facing mounting troubles due to the region's worsening property market. China credit reporter Trista Siniluo joins us from Hong Kong. So Trista, you typically cover China real estate. You've been talking about Vanke extensively for us. Talk to us today about what you're seeing in UOB's big bet on China, on Hong Kong real estate?
So UOB has, over the couple years has been financed lots of real estate deal in Greater China, and more than 40% of its loans is Hong Kong branch made, actually property related. So that's a higher concentration than its Singapore peers and some other banks here. And this year we are increasingly seeing that UOB has to, walk through some deals that borrowers are struggle to finance or even default on. So that's the big bet we are seeing that UOB has made right now is facing backfiring.
What has been its approach to dealing with these loans?
So UOB has, held off calling some repayment on these loans and trying to renegotiate it with those borrowers and trying to roll over the debt. Some example we're seeing here are, UOB has recently refinanced an over 900 million loan that tied to Hong Kong builder Parkview Group after months of negotiation. And the underlying asset is actually a shopping mall in Beijing, and that, the rental income created from that shopping mall is actually cannot cover the loan interest. And also earlier this year in September, UOB rolled over a 10 billion Hong Kong dollar loan that it lent to defaulted developer Shimao in Hong Kong. And it has previously tried to offload that to private credit investor actually. And so that's the current reality we are seeing. And, in early November, UOB actually made over $400 million a general provision for its commercial real estate exposure that could go bad in the future. And so that's, I think, UOB is making, some more approach and trying to deal with these troubled loans.
Certainly these ripple effects from the Chinese property market all the way to a lender here in Southeast Asia as well. Trista, thank you. Bloomberg China credit reporter Trista Siyi-Luo. We're also on correction watch for Chinese stocks this morning after they neared key bearish technical levels on Tuesday. We're seeing fading tech gains, renewed economic concerns. All this has been fueling a sharp sell-off. Our Asia equities reporter Winnie Su is with us now. So Winnie, we've been seeing some weakness into Chinese stocks, expectations that they will continue?
Yeah, exactly, Avril. Like you mentioned, over the past 2 days or even just over the past few sessions, there has been that weakness really showing up. And like you mentioned, we are closely watching these milestones. We're talking about the MSCI China just closed in that technical correction territory. And also HSCI briefly crossed that level yesterday. But for now, more significantly, we are watching for the HS Tech to reach that bear territory, which means down about 20% from its recent high. We're just about less than 1% away from that level. Yes, a lot of it is about profit taking towards the year end, because when you take a step back, we're talking about the MSCI China up around 30% so far this year, almost doubling the gains in the S&P 500. So it's not that rare to see investors taking a bit of money off the table as we head towards end of the year and a bit of lack of a new catalyst. However, there is these renewed concerns when it comes to the economic weakness, especially when we've got that disappointing numbers from Monday, really showing the weakness in the retail sales, for example. So it's showing how these stimulus expectations haven't really been translated through, and that we are not really expecting further big stimulus from the government. So a bit of kind of readjustment there from investors, and hence still some weakness expected in the near term.
Is that readjustment also part of what's driving divergence between onshore, offshore?
Yeah, that is actually another very interesting trend that we are observing, as they seem to be also coming hand in hand, especially when we take a look at how just these recent performance has been for the CSI 300 in the past month, down about 2% versus HSCI offshore stocks down about 6%. And it is part of that global rotation away from tech that's driving kind of these underperformance of the Hong Kong listed Chinese shares, but also southbound flow quite muted these days. So you're talking about the main buyers of these Hong Kong shares not really being supported anymore, and that they're not as interested in buying the dip at this moment. But also when you look at policy, right, the policy direction is about boosting consumption and boosting domestic demand. So investors are more likely to look at opportunities in these non-tech sectors. And when we talked to Hao Hong yesterday, he was saying that this kind of sectoral rotation usually can last for quarters, and at least we're likely to still see that divergence for the next quarter. And it is quite a reversal from what we saw earlier this year when the H shares really outperformed A shares on these tech optimism.
So optimism seems to be figuring a lot in this conversation. What are investors expecting longer term next year?
Yeah, exactly. You know, we kind of did that year-end outlook for next year earlier in a few weeks back, and it was a lot of optimism, but that seems to have turned a little as we see these recent weakness. And when we take a step back, we're really talking about how transformative this year has been for Chinese stocks, going from uninvestable to indispensable for some of these global investors, especially the ones in Asia and in Middle East. But the question here is, will these money from foreign investors, long-only investors in the U.S. or in Europe come in? And that really, for now, hinges a lot on the economic revival of the country. When we talk to them, they say, yes, they're expecting further gains in the Chinese stock market, driven by the tech optimism and policy. But they have to see these earnings continue to improve, and that the 5-year plan really kick off, and the focus on anti-involution really starts to translate. So until we see that, it's quite difficult to convince foreign investors to step in. And when we talk to Man Group, for example, they were saying that they're hearing a bit more nervousness when it comes to their client in terms of how this gap between the market rally and the weak economy hasn't really been closing. And I guess just to wrap up, it really is, as one fund manager put it, that deflation, soft consumption, real estate problem, and involution still remains problems not really definitely resolved at this point.
Okay, so maybe take a while more to shake off that uninvestable label completely, despite these opportunities. Winnie, thank you so much. Bloomberg Asia Equities reporter Winnie Su. Now, some other corporate stories we're tracking. Bloomberg has learned that China's Luckin Coffee is mulling a bid for Nestlé's Blue Bottle coffee to boost its brand profile and expand in the premium coffee segment. Sources say Luckin is also evaluating other acquisition targets, including the operator of Percentage Arabica coffee stores in China. Founded in 2017, Luckin has expanded with thousands of stores offering low-cost coffee, surpassing Starbucks in store numbers in China. China Vanke has unveiled a revised bond extension proposal for creditors to vote on as it makes another attempt to gain support for a plan to avoid default. The company is offering to pay 60 million yuan in interest due on December 15th by the end of Monday, and is proposing to extend its grace period to 30 trading days. Vanke is scheduled to hold a bondholder meeting on Thursday to discuss the latest proposal. The information is reporting that Apple is planning a major expansion of its smartphone line that could see it selling at least 7 new models of its iPhones by fall of 2027. Sources say the company will release its first foldable iPhone in fall 2026, which will have a wider than tall appearance when unfolded. Apple is also expected to release a 20th anniversary edition of the iPhone in 2027. We have more ahead on the Asia trade. This is Bloomberg. let's take a look at one trade that has really done very well this year. We're talking about precious metals, particularly gold. And this is despite pretty tepid U.S. jobs data and seeing those yields, particularly on the 10-year, they are holding up. What does this mean for the prices of the yellow metal along with some of these other commodities? Let's get markets perspective with Joni Teves, precious metal strategist at UBS Investment Bank. So, Joni, great to have you in the studio with us. We've just been talking about, how yields are at these levels, and yet gold is doing as well as it is. Do you see more to run? What do you think is driving that continued performance?
Sure. So we remain bullish gold into 2026. We think the main driver really has been diversification among investors and also supported by strong demand from the official sector as well as from retail consumers. And this basically has caused kind of a change in the relationship between gold and traditional macro drivers like the U.S. real rates and the U.S. dollar. So gold has been a lot more resilient to periods when rates are higher or the dollar is stronger because of these very strong diversification flows in this environment where there's a lot of macro uncertainty and geopolitical risks.
Yeah, I mean, today we're hearing from the U.S. president, right, talking about how they're ordering a blockade on Venezuela. To what extent is the geopolitical risk going to continue being a key driver in 2026, you think?
I think geopolitical risks are one of the reasons why investors want to have a more diversified portfolio, and that has benefited gold. But looking at how geopolitical events have impacted gold in the past, it tends to be a knee-jerk reaction when the event happens, but that premium tends to fade over the next few months. So we don't think there's a direct geopolitical risk premium baked into gold right now, but it is one of the list of reasons why diversification flows in general have been very strong towards gold.
Do you expect more so-called debasement next year, and to what extent is that going to flow through into gold?
So de-dollarization and currency debasement, these are themes that a lot of market participants have been talking about. As far as we're concerned, it's not really de-dollarization or debasement specifically that has been driving gold. We think it goes back again to diversification, particularly as investors become more concerned about fiscal sustainability, debt sustainability among major economies. Gold is acting as an alternative currency to an extent and a way to hedge against fiat currencies. And again, goes back to the point of diversification and wanting to build a core allocation in gold as part of the portfolio.
So how much of the portfolio should gold be accounting for?
It's very difficult to say. I think it really depends on the type of investor, the risk appetite, what else is included in the portfolio. A lot of conversations among market participants do point towards 5% as a reasonable percentage of gold to hold within a portfolio. But I think it really depends on a lot of different factors.
Okay, talk to us about your price target for the yellow metal and the extent to which you expect that outperformance versus silver, because that's actually done, if you take the year-to-date performance, even better this year.
Yeah. So with regards to our price expectations on gold, we think a lot of the gains will be front-loaded in the first half of next year. So we are looking for a 47.50 target over the next couple of quarters. With regards to relative performance to silver, I think silver is in a good position to outperform gold next year. So as gold makes new highs, silver is also poised to make new highs. And particularly given supply and demand fundamentals for silver are quite compelling, where we expect the deficits to continue. I think silver is in a position to outperform and for the gold-silver ratio to drop. However, there's a key difference between gold and silver. Silver tends to be more of a tactical play for many investors versus the long-term strategic nature of interest in gold. So we think that kind of outperformance is unlikely to be sustained. It is going to be patchy. So silver will outperform during certain periods, and then there will be some sort of readjustment, and then it might outperform again later on. So I think quite a bumpy kind of path for silver, both in terms of absolute price levels as well as relative performance to gold.
So not quite a straight line, but where do you see silver this time next year?
Well, we expect that in the second half of the year, gold starts to taper off as the bull run starts to mature, the Fed easing cycle starts to approach its end, and growth starts to recover. We would expect that silver follows a similar path to gold, but prior to that, we do see key upside risks to silver, and if given where the gold-silver ratio is right now, that implies that given our target for gold, silver could approach kind of above 70 levels. And if the market starts to test the gold-silver ratio long-term average around 61, then that could imply that silver could rally towards high 70s, towards $80.
Can I ask you about platinum and palladium as well? I mean, we got U.S. retail sales and it showed the auto component is struggling. How is that affecting the demand outlook, and does the supply side of things maybe matter a bit more next year?
Yeah, so for platinum and palladium, it's really been more of a supply side driven story, but there are upside risks on the demand side particularly if the move towards electrification slows down a lot more than we expect. So that could be a positive surprise for the platinum group metals. And I think a key upside risk actually comes more from the fact that there have been starting to be signs of tightness in the market with both metals currently in backwardation. So if that continues, then we could see potential kind of liquidity issues come up, and that could have a considerable impact on the spot price.
Joni, we'll leave it there for today. Great to chat. Thank you for coming in. Joni Teves, precious metal strategist at UBS Investment Bank. Now turning to other commodities, we're looking at oil as well, following on from Trump's social media post talking about ordering that blockade on Venezuela. Certainly we are seeing that knee-jerk reaction in terms of a jump higher in U.S. crude futures or WTI, but the focus on the market is still quite squarely, I think, on this glut that is expected to maybe, according to some, turn into a super glut in 2026. You are seeing the energy names in the Asia Pacific still coming under pressure following those moves lower overnight in oil prices. We have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade, and we're counting down to the open of Chinese markets. China will have another major chip debut today. It's one that's eagerly anticipated by stock market investors after the stellar gains of its peer More Threads earlier this month. Let's bring in our China correspondent, Min Min Lo, in Hong Kong. So we're talking about MetaX. Min Min, tell us more about this chip startup.
Hey, Avril, this is something that we are watching very closely because it is started by an ex-AMD employee. Three of the founding members were previously working at AMD, and it really reminds me of More Threads, which is started by an ex-NVIDIA employee. And the retail portion of the IPO was oversubscribed by 2,900 times. So enormous interest from retail investors. And we saw More Threads just debuted about over a week ago, flipping by about 500% on the first trading day. And it really tells you that there's a lot of interest in these chips startups that could benefit from the domestic substitution theme in China, especially given China is trying to, create its own homegrown industry to increase its resilience amid the export controls from the US.
So are we expecting more such chip listings then?
Yes, because the Chinese government has been creating policies to really support even unprofitable companies to list on Shanghai star market. So MetaX is one that is still making losses. More Threads also. So we are expecting other companies like Changxin Memory Technologies, Yangtze Memory Technologies, potentially seeking IPOs in Shanghai as well. Of course, we know Baidu is looking to spin off its chips arms to list in Hong Kong as well. And so far, there's been a a lot of interest, especially in onshore IPOs, which are seeing an average of a 250% pop on the first day of trading, partly because the government has also been putting a lid on the number of issuances.
Min, you've also, in Hong Kong, been speaking to an important crypto exchange player, that's HashKey. You spoke to the CEO. We're watching the debut of the firm. Tell us more about that.
Yeah, so watch the full interview later, 9:30 a.m. local time. I can't tell you too much about what the CEO told me yet, but this is a company that is a leading crypto exchange in Hong Kong. It's also got license to operate in Singapore, Japan, UAE as well, and its licensing regime so far, it's one of its key advantages here. The thing is that it's also loss-making at this point in the first half of this year, making about 500 million Hong Kong dollars in losses. And according to Bloomberg Intelligence, our in-house analysts, they say that this round of IPO will be able to raise enough funds for the company to last maybe 70 to 90 months of cash flow. They still expect this company to be loss-making for another couple more years. But one that is interesting to watch as the company hopes to expand further overseas.
We'll certainly be staying tuned for that interview. Min, thank you so much. Our Bloomberg China correspondent, Min Lo. Let's take a look at how futures are faring in the Greater China markets. It was a bit of a struggle yesterday, and that's a bit of an understatement. We saw tech really dragged under. We're watching for those technical levels. Are we going to see that bear market? And we are seeing Hang Seng futures, of course, pointing to a little bit of downside. So is there optimism maybe that it will stabilize a little in trade this midweek edition? That's it from the Asia Trade for now. Markets coverage continues. This is Bloomberg.